Long before tractors symbolized modern agriculture, American farming depended on animal power and manual labor. Harvesting grain was slow and physically exhausting. In the 1830s, Cyrus McCormick introduced a mechanical reaper that dramatically increased output per worker. The machine did not simply improve efficiency, it reshaped farm economics by reducing labor dependence and expanding cultivated acreage. McCormick relocated operations to Chicago in the 1840s. The decision was strategic. Railroads were transforming distribution networks, and Chicago sat at the center of Midwestern grain production. Manufacturing near rail lines lowered shipping costs and accelerated market reach. By the late 19th century, agricultural equipment production had become a competitive and capital-intensive industry. In 1902, financier J.P. Morgan consolidated several major manufacturers, including McCormick Harvesting Machine Company and Deering Harvester Company, into a single corporation, International Harvester. The merger created one of the largest industrial enterprises in the United States. Initial capitalization exceeded $100 million, and the combined workforce reached tens of thousands. The company immediately dominated the American farm equipment market. Its product portfolio included reapers, binders, threshers, and later tractors. Vertical integration became central to its structure. Steel processing, engine production, assembly, and distribution operated within coordinated corporate systems. Scale reduced per-unit costs and strengthened dealer networks nationwide. Tractor technology accelerated in the early 20th century. Gasoline-powered machines replaced horses and mules across expanding farms. Mechanization increased crop yields and consolidated farmland into larger operations. International Harvester competed aggressively in this transition, introducing tractor lines that gained strong brand loyalty among Midwestern farmers. World War I expanded demand for agricultural output as European production declined. International Harvester increased manufacturing capacity to support domestic and export markets. Diversification followed during the 1920s. The company entered truck production, refrigeration equipment, and industrial engines. Diversification was intended to stabilize revenue against agricultural cycles. The Great Depression sharply reduced farm income. Equipment purchases slowed dramatically. International Harvester survived in part because its truck and industrial divisions generated alternative revenue streams. Cost controls and extended dealer credit helped sustain relationships during weak demand years. World War II transformed the company into a key industrial supplier. Factories produced military trucks, engines, and mechanical components under federal contracts. Employment surged. Industrial output expanded across multiple facilities in Illinois, Indiana, and Wisconsin. The post-war era marked peak scale. Agricultural mechanization deepened as farm sizes expanded and labor shortages persisted. The Farmall tractor line became a recognizable symbol of American agriculture. By the 1950s, International Harvester controlled roughly one-third of the U.S. farm equipment market. Its truck division ranked among the nation's leading commercial vehicle manufacturers. Global employment exceeded 200,000. Scale, however, required constant reinvestment. Manufacturing plants were large and heavily unionized. Pension obligations, healthcare commitments, and wage agreements expanded during decades of profitability. Vertical integration created operational strength, but also embedded high fixed costs. During the 1960s, competition intensified. Deere & Company refined production efficiency and dealer networks. European and Japanese manufacturers began introducing cost-competitive equipment into international markets. Research and development expenses increased as tractors grew more powerful and technologically complex. Emission standards and fuel efficiency improvements raised engineering costs in the truck division. Maintaining leadership across multiple heavy manufacturing categories demanded significant capital. Inflation in the 1970s accelerated input costs. Steel prices rose, energy expenses increased following oil shocks, interest rates climbed, raising borrowing costs for both the company and farmers financing equipment purchases. Equipment demand fluctuated with commodity prices, producing volatile revenue cycles. By the late 1970s, International Harvester remained powerful but financially stretched. Revenues exceeded $8 billion annually, yet profit margins narrowed. High plant utilization was required to absorb fixed costs. Underutilized factories quickly eroded profitability. At the same time, labor negotiations grew increasingly tense. Union contracts included cost-of-living adjustments and long-term benefit obligations, negotiated during stronger economic periods. Management argued that global competition and rising costs required moderation. Labor representatives pointed to historical scale and productivity. The structural foundation that once ensured dominance, massive plants, vertically integrated production, long-term labor agreements, had become financially rigid in an era demanding flexibility. International Harvester entered 1979 as a diversified industrial giant with shrinking margins and limited room for operational error. Contract negotiations between International Harvester and the United Auto Workers collapsed in the fall of 1979 after months of escalating tension. The disagreement centered on wages, cost of living adjustments, work rules, and long-term pension liabilities. Management argued that rising global competition and declining margins required structural cost restraint. Union leadership countered that productivity gains and decades of profitability justified continued wage protection. In November 1979, approximately 35,000 union workers walked off the job. Major manufacturing plants in Illinois, Indiana, Kentucky, and Ohio halted operations. Assembly lines producing tractors, combines, trucks, and engines went quiet. The strike would last 172 days. For a capital-intensive manufacturer dependent on high utilization rates, the shutdown was financially devastating. Fixed costs, including salaried staff, utilities, debt service, and facility maintenance, continued despite minimal production output. By the time operations resumed in April 1980, the company had lost an estimated $600 million. Seasonal timing compounded the damage. Agricultural equipment sales follow planting and harvest cycles. Missing key production windows meant farmers who needed machinery could not wait for resolution. Many turned to Deere or other competitors with available inventory. Lost orders during peak seasons were difficult to recapture. The truck division experienced similar disruption. Commercial fleet buyers required reliable delivery schedules. Uncertainty surrounding the strike led many customers to redirect purchases to alternative manufacturers. Once supply relationships shift in heavy equipment markets, regaining contracts requires years, not months. Cash reserves tightened quickly. International Harvester relied increasingly on short-term borrowing to cover operating obligations. Interest rates during this period exceeded 15% in parts of 1980 and 1981. Significantly raising financing costs. Credit rating agencies reassessed the company's risk profile, adding further pressure. The broader economy deteriorated simultaneously. The early 1980s recession reduced industrial output and farm income. Commodity prices fell after the export boom of the 1970s subsided. Farmers facing declining revenue postponed equipment purchases. Agricultural land values dropped, constraining borrowing capacity. Production resumed under a negotiated settlement, but the financial damage lingered. Market share had eroded during the shutdown. Dealer networks faced strained liquidity after months without new inventory. Inventory imbalances appeared as production schedules struggled to align with weaker demand conditions. Operating leverage magnified the downturn. Large plants built for high-volume throughput now ran below capacity. Lower output increased per-unit costs because fixed overhead had to be absorbed across fewer machines. Discounting eroded margins further as dealers attempted to clear aging stock. Pension and healthcare obligations continued expanding regardless of production levels. Long-term benefit commitments negotiated during earlier decades now represented significant actuarial liabilities relative to shrinking earnings. The strike did not create International Harvester's structural challenges, but it accelerated them. The combination of lost revenue, higher borrowing costs, declining agricultural demand, and rigid cost structures compressed the company's margin for recovery. By 1981 and 1982, management confronted limited options. Modernizing factories required capital the balance sheet could not comfortably support. Maintaining full divisional scale under reduced demand proved unsustainable. Strategic reviews shifted from growth planning to asset evaluation. International Harvester emerged from the strike still operational, but weakened. Competitive positioning in core agricultural markets had narrowed. Debt levels had risen. Confidence among dealers and customers had been tested. The financial shock shortened the timeline for decisions that had been debated internally for years. Financial disclosures from 1980 and 1981 reflected the severity of the contraction. Net losses replaced prior cyclical profits. Working capital ratios deteriorated as receivables slowed and inventory turnover weakened. Analysts noted that the company's break-even point remained high relative to competitors with more modernized facilities. Capital expenditure programs were reviewed line by line. Projects intended to upgrade manufacturing automation were postponed. Engineering development budgets were trimmed, slowing the introduction of next-generation equipment. While cost reductions preserved liquidity in the short term, they risked reducing long-term competitive innovation. Dealer networks felt secondary pressure. Floor plan financing costs rose as interest rates climbed. Dealers carrying unsold tractors and combines faced rising borrowing expenses on inventory. Some smaller dealerships exited the network entirely, reducing distribution density in rural markets. At the same time, global competition intensified. European manufacturers expanded into North America with fuel-efficient and smaller-scale equipment suited for diversified farming operations. Japanese firms, known for lean manufacturing techniques, offered reliable machinery at competitive price points. International Harvester's larger, more complex production system struggled to match those cost structures. Internal restructuring committees evaluated plant utilization across the Midwest. Certain facilities operated at substantially below optimal output. Consolidation scenarios, projected workforce reductions, and regional economic impact, the scale that once delivered efficiency now imposed inflexibility. The cumulative effect was measurable. Market share in several key tractor categories declined during the early 1980s. Earnings volatility increased quarter to quarter. Lenders demanded clearer recovery plans before extending additional favorable credit terms. By late 1982, leadership no longer framed the situation as temporary cyclical weakness. The financial models increasingly assumed structural downsizing would be necessary to preserve solvency and restore sustainable margins. By 1983, restructuring was no longer theoretical. International Harvester's leadership moved from cost containment to structural reduction. The company could not sustain its diversified scale under existing debt levels, shrinking agricultural demand, and weakened cash flow. The agricultural equipment division, historically the corporation's foundation, required significant reinvestment to remain competitive against Deere and emerging international manufacturers. Modern tractor development demanded updated transmission systems, improved hydraulics, electronic monitoring components, and more fuel-efficient engines. These upgrades required capital that the balance sheet struggled to provide. After extended evaluation, management chose divestiture. In 1984, International Harvester agreed to sell its agricultural equipment business to Tenneco Inc., the parent company of J.I. Case. The transaction, valued at approximately $2 billion, transferred production facilities, dealer networks, and product lines into what became Case IH. The sale marked a historic shift. The company that had introduced mechanized harvesting to American farms no longer controlled its farm machinery operations. The red tractors remained in fields, but they were no longer built by International Harvester as an independent entity. Proceeds from the transaction were used to reduce debt and stabilize liquidity. Interest burdens declined as leverage ratios improved. However, asset sales reduced overall revenue scale. International Harvester shifted focus to its truck and engine divisions, segments considered more viable under the new financial structure. Workforce reductions accompanied the restructuring. Thousands of employees transitioned to Tenneco or left entirely through layoffs and plant closures. Communities in Illinois and surrounding states experienced employment contraction as facilities consolidated or changed ownership. The remaining truck business required modernization as well. Emission standards tightened during the 1980s, requiring engine redesign. Freight cycles remained volatile. Management simplified product lines, closed underperforming plants, and concentrated resources on core heavy-duty vehicle markets. In 1986, the corporation formally changed its name to Navistar International Corporation. The rebranding symbolized the end of the diversified international harvester era and the emergence of a narrower transportation-focused manufacturer. Navistar continued producing medium and heavy-duty trucks and diesel engines, maintaining established dealer networks across North America. Though smaller than its predecessor, it retained technical expertise and manufacturing capability in commercial transport. The transformation reflected survival rather than expansion. Over 8 decades, International Harvester had evolved from agricultural innovator to diversified industrial titan. By the mid-1980s, it had contracted into a more focused enterprise, shaped by debt reduction, competitive pressure, and structural realignment. The factors driving this contraction were cumulative: rising labor costs, prolonged strike disruption, elevated interest rates, cyclical agricultural downturns, and intensifying global competition combined to erode financial flexibility. Divestiture provided liquidity, but ended the integrated industrial system created in 1902. International Harvester did not disappear entirely. Its legacy persisted through Case IH machinery and Navistar trucks. What ended was the original structure that once connected farms, factories, rail networks, and global markets under a single corporate umbrella. The company's arc illustrates how scale, once a decisive advantage, can become rigid when capital requirements increase and markets shift. The same vertical integration that powered early dominance demanded reinvestment levels difficult to sustain under financial strain. By the late 1980s, the diversified industrial empire had been dismantled. What remained was a streamlined transportation manufacturer, operating in a competitive but narrower field, carrying forward only part of the name and infrastructure that had once mechanized American agriculture.